You've heard of them, right? Sectoral mutual funds. They come with this big promise, a chance to get incredibly wealthy by betting on the next big thing. But what if that promise is actually a trap? Today, we're going to pull back the curtain and uncover the hidden hazards of these super high stakes investments. So, on one side, you have the promise find that one hot sector, jump in, and just watch your money explode. It sounds so simple, so tempting. But then there's the flip side, the brutal reality where these exact same funds can absolutely wreck your portfolio. So the question is, why? What's the hidden flaw that can turn a golden ticket into a total financial disaster? All right, so first, let's talk about the appeal. Why are we so drawn to these funds that focus on just one thing, like IT or pharma or banking? Well, it turns out the temptation is really powerful because it's based on a very simple and, let's be honest, a very compelling story. The core idea just feels so logical, doesn't it? You concentrate your money in one booming industry and you get to capture all that explosive growth. You hear tech is the future, so hey, you put your money in a tech fund. It makes perfect sense, right? Well, it turns out that this intense focus is also its greatest weakness. And that right there brings us to the heart of the issue, what experts call the diversification dilemma. And listen, this isn't some minor detail. It is the fundamental reason these investments can be so incredibly risky. It really just boils down to that classic mistake we've all heard about, putting all your eggs in one basket. If that one sector tanks, everything you've invested, it goes down with it. There's just no safety net. And to really see why that's so dangerous, let's just quickly compare it to how a normal, standard mutual fund is supposed to work. Its main job isn't to hit a home run. Its main job is to spread your risk. It takes your money and invests it across a whole bunch of different industries. Think of it like this. If the IT sector has a really bad year, well, strong performance in banking or pharma can help balance out those losses. See? That's the power of diversification. Your entire investment isn't riding on the fate of just one industry. A sectoral fund, on the other hand, does the exact opposite. It intentionally concentrates all of your risk. It basically rips away that safety net, leaving your investment completely exposed. If that one sector stumbles, there is absolutely no backup plan. So with the sectorial fund, 100% of your money is tied to the performance of one single industry, like information technology. If it booms, you win big, for sure. But if it busts, you can lose everything. It is quite literally an all-or-nothing bet. Now, this lack of a safety net creates three really dangerous traps for investors: brutal industry cycles, the impossible challenge of timing the market, and the massive amount of stress that forces you to make bad decisions. See, no sector stays on top forever. It's just not how it works. Every single industry, tech, real estate, you name it, it moves in cycles. They have these incredible booms, but they're always followed by devastating busts. And if you're all in on that one sector, riding that wave down can be financially and emotionally, well, brutal. And this leads to a classic and honestly a really painful trap. You hear all the hype in the news about some booming sector, right? So you invest your money, usually right at the peak. But by the time you're hearing about it, the smart money is often already on its way out. Then what happens? The sector's performance inevitably drops, you face incredible stress, and you panic, selling at the absolute bottom and locking in all your losses. The only way to really win with sectoral funds is to perfectly time your entry before the boom and your exit right before the bust. And let's be real, even professional fund managers with whole teams of analysts struggle to do this consistently. For a regular long-term SIP investor, it's next to impossible. And the volatility, wow, it is just brutal. I mean, you might see a 40% gain one year, which feels amazing, but the next year, it could plummet by 30%. And we all like to think we can handle that kind of swing, but seeing your money just vanish like that, it triggers a panic response that almost always leads to one thing: selling at the absolute worst possible time. So, does this mean sectoral funds are completely useless? Not exactly, but they are a specialized tool designed for a very, very small group of expert investors, and they are definitely not for most people who are trying to build long-term wealth. Okay, let's be crystal clear about who should probably just stay away. If you're new to investing, if you're building a retirement nest egg, if you're saving for your kids' education, or you're just a disciplined long-term SIP investor, these funds are simply not for you. The risk just far outweighs any potential reward for your core financial goals. Even for a savvy, experienced investor,
A sectoral fund should never, ever be a core part of their portfolio. At most, it should be a small, tactical bet. We're talking no more than maybe 5 to 10% of their total investments. It's basically play money, not your life savings.
So, how do you know if you're one of those experts? Just ask yourself this. Do you truly, deeply understand the nuances of market cycles? Are you actually prepared to actively track every single development in that sector? And finally, is this money a tiny fraction of your portfolio that you can genuinely afford to lose? If the answer to any of those is no, it's probably best to just steer clear. Here is the single most important takeaway, right here. Sectoral funds are tactical bets. They are short-term, high-risk gambles. They are not, and should never, ever be confused with, the core foundational investments you use to build a secure financial future. Okay, so if chasing hot sectors is a losing game for most of us, what's the right path? Let's talk about a smarter, more reliable way to build real, long-term wealth. The real secret, well, it isn't a secret at all. It's about getting the fundamentals right. You know, smart investing has never been about chasing the latest fad. It's about those boring but incredibly powerful principles: consistency, discipline, and, as we've seen today, diversification. And the good news is there are fantastic tools designed to do just this. For the vast majority of investors trying to reach their goals, diversified funds like flexi-cap funds, broad market index funds, or balanced advantage funds are just far superior. They do the job of building wealth with significantly less risk and a whole lot less stress. So, we'll end with a question for you. Take a look at your own investments and just ask yourself, what game am I really playing here? Am I chasing the temporary excitement of a risky bet, or am I methodically building real, lasting wealth? The choice, as always, is yours. Thanks for joining us.